and welcome. This is a very special edition of the ET Now show. I'm Aisha Faridi, and with just 4 more days to go for India's biggest tax reform, we get you this very special edition, Tryst with GST, the Street View. And for that, I'm joined by a very special guest, Gautam Chowcharia, Head of India Research at UBS. To just put it into perspective first, GST is likely to be a big game changer of a reform for India Inc. There's no taking away from that. And Dalal Street believes that the boost to GDP and earnings of India Inc. will happen, albeit very, very gradually. So let's go across to Ajay Sharma, my colleague from the research desk, and get in his perspective on the subject firstly. Ajay?
Well, there is no doubt about the fact that this is likely to be a game-changer reform for India as an economy and also for the markets. The near term is extremely clouded. We're already seeing companies across the country in the consumer space clear their inventory, and merchandise is flying off the shelves in order to not to be caught with some more expensive inventory, between the transition when this tax actually is overtaken by the earlier tax regime and GST comes in. So first 2 quarters of this financial year is when most of the economists we speak to and strategists we talk to regarding the markets believe the disruption would hit the numbers, both on the macro side and also on the micro side. But as we go into the year, in fact, the roughest estimates are that almost 75 basis points to 150 basis points is the kind of boost to GDP this tax regime alone can give, the full impact of which would only start be showing FY19 onwards, because analysts believe that 12 to 14 months is the lag effect the benefits of GST will start showing in. Also, if one were to look at the kind of companies which would actually be beneficiary and how would India Inc. be boosted for their earnings front once the efficiencies, once multiplicity of taxes go away and there are improved consumption pattern across the country. They say that almost 200 to 400 basis point, which means 2% to 4% boost to BSE 100 companies can be seen overall on the aggregate earnings front FY19 onwards. So clearly, there is a consensus that over the long term, it's a big positive for the economy as well as for markets. But in the near term, it can weigh in on the macro numbers as well as the earnings.
Okay, Ajay, thanks for really setting the stage for today's discussion with our very special guest, Gautam Chowcharia from UBS. Gautam, hi evening, and you seem to be clearly in sync with Ajay's analysis that at best GST is going to be just a marginal impact and everything around it is largely noise.
For the near term, yes, I completely agree. Longer term, we all know it's a great reform, helps productivity, but that's over the longer term.
Right. So why do you believe that, at best we're just going to have a very marginal impact from GST? Are you not in sync with most market participants who are busy calculating how much of an earnings impact or damage and dent we're going to see because of GST? And the transition process, which is going to last perhaps as long as 3 to 5 months, who knows?
So again, who knows, as you said, but in any near-term disruption on earnings from GST, we may see that playing out in the second quarter earnings. But again, you have to remember 2 things. One is it's not going to be a permanent damage. It's not something which is killing demand in a structural or a long-term way. It will be largely the inventory cycle, which will come back in the third quarter and the fourth quarter. So the aggregate impact on fiscal year 18 numbers is going to be marginal in our view, unless it itself leads to a vicious cycle. And as you said, who knows if it's a 3 to 5 year process, a 3 to 5 month process. Secondly, why we think the disruption may not be significant, save excluding a big glitch in the IT systems, etc., is that the ecosystem is aware of GST coming through because of the continuous delays. So when we have seen GST being delayed for last year, last 2 years, it's also made the ecosystem far better aware and far better prepared. You have to remember that in a complex country like India, the ecosystem will never be fully prepared for something like GST. So there will be challenges, but the preparedness level is definitely far better than say in November last year when we had hopes for GST implementation or a year before.
So would you derive the conclusion that it's not the amount or the quantum of rates, but the formalization of such a big reform process itself, that's the key positive, and that's what the market should focus on?
Absolutely, absolutely. So again, we have been seeing over last 1 year a lot of debate, discussion around which sector will get what GST rates, stock prices reacting to that. It was much more so last year when there was a lot of speculation in the market about these rates. But our view is that one, the rates no one knows till it's decided. We finally have clarity, but a year back definitely no one knew. Secondly, the rates are decided by the GST Council. And so it's no longer just the central government deciding rates, but the GST Council, which represents states also. And thirdly, given the anti-profiteering clause, it's quite likely that the benefits of GST, etc., get passed on. And we have seen over the last 2-3 years, at least selectively, the company's pricing power being evident in terms of being able to pass on any cost pressures. So in most cases, our view is that the GST impact will be largely passed on to the consumers, and therefore the impact or therefore the stock price reaction around rate differential in our view is overdone. The formalization part is an obvious big theme around GST. That's a theme we've been talking about for last 3 years. GST is one of India's 3 arrows, and that remains the biggest positive from this reform process for Indian companies and macro longer term.
You know, again to the same point then, and analyzing the amount or the quantum of this disruption or the transitionary phase. How disruptive, Gautam, could GST be? Because it's not like we're going to stare at a scenario of 0% earnings, right? The earnings will come in. After all, we're a consumption-led economy. What's the quantum of the earnings impact that you may have calculated purely available on the kind of information or the amount of information that we yet have?
It's still very early days, frankly, and again, there's no numbers to quantify because this initial for the June quarter numbers, it will primarily reflect the inventory preparedness of the system, so it could hurt the June quarter numbers a bit. But for the July quarter earnings numbers, July to September, the numbers will reflect whether the demand impact is also there beyond the inventory impact, because the inventory impact will get normalized in the course of July and August. And then if the demand remains at normal levels, the impact will be just quarter to quarter phenomena rather than an aggregate. So the key debate here is whether GST as a disruptive force also causes demand destruction in the form of immediate dislocation in supply chain and job losses. So unless GST forces, for lack of a better word, immediate short-term formalization, I fail to see how it will be materially disruptive to the broader trajectory. Now, having said that, I would like to point out that our view on earnings growth and earnings trajectory, excluding GST, is not as positive as market hopes. So we have been arguing for last 3 years and still argue that the growth recovery in India will be muted because of lack of a capex cycle primarily, and that view has not changed. So just because of GST, unless we see big job losses, I don't see any material impact near term.
Interesting point and observation that I was going through in your notes. I mean, you know, and it's surprising and even a talking point, because we just had Hasmukh Adhya today speak exclusively with ET now, and he's saying that inflationary concerns will appear in the due course of time because of GST implementation. But you continue to believe that it's going to be a very limited impact on CPI. Why is that? What gives you that kind of conviction?
Absolutely. One, the constituent of CPI itself, so half of the CPI is food and therefore largely unaffected by GST. Secondly, if you look at the rates which the GST is coming with, for most of the CPI basket, the rates are neutral to in fact lower in some cases. So in aggregate, purely from a CPI basket and print perspective, the inflationary impact is likely to be limited. But obviously, if you're looking at the higher income population, they might see some cost increases in some particular products. But aggregate level, I don't worry about GST being inflationary.
So very quickly then, what's priced in and what's not? Would today's weakness in the equity markets, a one-month low and a fall sub 9,500 at all be attributed to GST nervousness? Because up until now, the stance of everyone has been that GST is a known devil. It's already in the price.
It's difficult to pinpoint one day's fall for particular events. We also had the events around the banking sector over the weekend. So it's difficult to pinpoint whether it's GST nervousness or whether it's the result of a more proactive RBI in resolving NPL issues. So difficult to say that. But in our framework, we do think the long-term structural benefits of GST is reflected in all-time high multiples for Indian markets, despite earnings growth being in the lower end of the long-term averages. So in that sense, the benefits of GST do seem to be priced in terms of Indian markets, and specifically sectors and stocks which should be big beneficiaries of GST. There also the valuations reflect that the benefits are priced in. So if we see prolonged disruptive impact of GST, which is not our base case, then that is definitely not priced into the stocks.
Okay, and that's exactly what we're going to talk about. Talk about the earnings impact for various sectors and the coverage under UBS. After the break, my colleagues Vivek and Mubina will be joining in. Vivek will get you the sectoral impact from the GST implementation, and Mubina will talk about what CLSA has gathered from its channel checks with regards to consumer sector dealers. Back with Tris with Destiny, the Street View, our very special edition, and still in conversation with UBS's Gautam Chowcharia. The question we're all asking is, how does GST impact taxation across sectors, and what kind of earnings damage, if at all, could we see? So we assess the impact on India Inc. with a research team throughout this week on how the taxation migration will affect businesses across industries. Vivek and Mubina join in for exactly that. But Vivek, first to you, walk us through how auto companies are gearing up to face the new tax regime, and which segments of hospitality business are bound to benefit.
Well, overall, if you're looking at it, GST appears to be tax neutral for the entire auto industry. And if you're looking at it, the small cars and for petrol as well as diesel, if you're looking at it, small cars, petrol, there's been a marginal drop in the tax rate post GST. While for the diesel segment, there's been a marginal uptick. Now, remember, whenever we talk about GST on auto segment, there are additional cesses over and above that of GST. So, if you're looking at it, the small cars have an additional cess of 1%, the mid-size cars have an additional cess of 3%. And luxury cars have an additional cess of 15%. However, if you're looking at the luxury car segment, over and above the 28% GST on autos plus the 15%, if you're looking at it, the overall tax incidence on the luxury segment actually becomes slightly lower than what it is currently. So if you're looking at large and luxury cars, which is why you're looking at this segment actually getting slightly cheaper for the customers. Now, other than autos, let's also focus on some of the other sectors to keep a track on. Farming equipment, tractor as well as farm equipment. Now look at this. Tractors, from the current rate of 6 to 7%, it has actually gone up to almost 12%. So tractors will definitely get more expensive post the implementation of GST. While if you're looking at the farm equipment, again, look at companies like LG Equipment, you've actually seen the tax incidence go much higher. However, till right now, they weren't getting any tax credit inputs. Now they will get that. Now, if you look at the construction space, iron and steel, most of them, they've been bunched up very close to the GST tax slab where they were currently. So overall, if you're looking at it, not too much change. However, looking at sand and aggregates, etc., it has become much cheaper from 19%. The effective GST rate now is just 5%. So quite a good positive over there. Now the hospitality space, again comes up into three different segments. Hotels above 7,500 rupees. This is one segment that has been taxed at the highest bracket of 28%. And lastly, the one sector that most of the people are talking about when GST came in, the logistics space, finally a lot of clarity coming in over there. Now remember, regular, if you're looking at it, 4.5% is the current rate, going up to 5% marginal change. However, the express cargo segment and some of the carriers, who are present in the express cargo segment, they will definitely benefit. The current tax rate of almost 15% comes down to 5%. So some of these stocks, which are present in the express cargo stage, they are going to be major beneficiaries.
Okay, Vivek, thanks for that detailed update. And Mubina then joins in to talk about CLSA's view on consumer companies and as to how, Mubina, they're cautious before GST implementation.
A high level of anxiety. That's what CLSA is suggesting when it comes to consumer firms. All the channel checks are suggesting that while, of course, most of the firms are prepared for GST, it's just that high level of anxiety because of the fact that, we are stepping into an era of uncertainty. The entire transition process is something that's going to lead to significant pain, significant disruption in the entire channel. In fact, what CLSA says is that a lot of firms are willing to compensate distributors for that one-time loss in relation to transition to GST. It's a widely well-known fact that a lot of retailers as well as wholesalers are resorting to destocking when it comes to consumer staples, and for the month of June 2017, there may be a year-on-year decline. Additionally, they also go on to say that, distributors are, of course, we do have all of those discounts, the advancement of the end of year, end of season sales rather that have come by just to clear off the inventory that retailers and wholesalers have on their books. But more importantly, CLSA also says that, what's actually concerning a lot of firms is the fact that because of the increase in cost of doing business, it's something that may hurt their margins as well as their returns.
Okay, Mubina, Vivek, thanks both of you for putting everything into perspective. And Gautam, the one sector that under your coverage, apparel and others, such a large unorganized segment of almost about 70%. You think the transition would be a little disruptive for them? Would it again be an inventory level hit? Or do you think it is going to be an earnings impact which we're going to see eventually?
So in the near term, at most an inventory level hit, but again, given the sale, etc., we are seeing the June quarter looks like they are taking a proactive approach, and as long as there's no demand destruction, it's going to be a quarter-to-quarter transition rather than something to worry about. Longer term, obviously, the informal sector should get formalized as they become part of the net, and therefore will benefit the organized companies in that space.
Durables, the other segment. When it comes to kitchen appliances, it's a good 40 to 60% unorganized market that we're looking at. For electrical appliances, it's about 20 to 40%. Is there possibility that a demand could be hit? I mean, what explains all those showrooms going empty shelves right now, trying to slash out discounts on all product categories? I mean, what is it that we're staring at post-GST?
So GST can hurt demand only in a scenario where the disruption to the informal sector is severe and quick, and which leads to job losses. So which you're looking at a really pessimistic scenario. That's not our base case. It's something similar to what we initially saw in the very, very initial phases of demonetization. But as we saw in demonetization, people come back, find a way to get around things, and similarly we'll see that happening. So the proper disruption, when because of the common IT network, because of the credit mechanism in GST, the system gets formalized. That in our base case is a medium-term phenomena and not something which will play out in 3 months or 6 months. So, but if it does play out in 3 to 6 months, that's when we start seeing demand getting impacted a lot in the short term. Otherwise, we're just talking about uncertainty, rate differential, inventory issues, which are all purely short-term issues, which in our base case, the markets will likely ignore.
What would be then the case for a diverse sector like autos, because it has many segments on offer and the rates vary from luxury to small cars to two-wheelers to tractors, all jumbled up in one basket? What could be the earnings impact that you've assessed?
So again, no hard numbers per se, but in our view, largely unlimited if you, largely insignificant if you look at the aggregate earnings impact over fiscal year 18. You could see quarter-to-quarter disruption depending on how the companies are positioned in the inventory, but aggregate fiscal year 18 impact will likely be limited.
The other two segments under your coverage, hospitals, again a large unorganized sector of almost about 70%, and the other one like ceramic tiles with Kajaria under your coverage, and again a 50% unorganized sector. Would these two sectors stand to benefit when it comes to earnings, because there is going to be a large shift from the unorganized to organized plays?
Absolutely, but again over the medium term, not in the next quarter or 2 quarters.
Okay, fair point. So net, what you're saying, Gautam, that there is going to be a transition impact, but that's only going to be very temporary in nature, right? Is that how we can conclude this argument?
Yes.
Okay.
Exactly. So the earnings impact might be seen in 1Q, 2Q because of inventory, but not FY18 aggregate numbers.
Okay, on that positive note, we're going to wind it up then on this very special coverage. Gautam, great speaking with you. Thank you so much for taking the time out and really analyzing what kind of an earnings impact could GST have. Seems like it's negligible for now. It could be transitory in nature. It's going to take its time, maybe 2 quarters, 3 quarters, but by then things should definitely stabilize. With that, we're going to wrap it up on this very special edition of Tryst with GST, The Street View.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.